Welcome, everybody, to Tokens of Wisdom. I'm your host, Dave Rothschild, and joining me today in the Tokens of Wisdom studio is Gautam Ganeshan, partner at KPMG. Now, before we dive into the episode, please listen to the disclaimer at the end of the show. Nothing I say or Gautam says is legal advice, investment advice, or tax advice. Gautam's joining us here to share his considerable fund-related wisdom, but everything he shares is his own personal opinion for educational purposes only. On this show, he's speaking for himself and not for his employer or any affiliated entity. And now that boring stuff's out of the way, we can get to the real fun and talk about digital asset fund audits. Woo! Gautam, thank you for joining us.
Thanks for having me on the podcast, Dave. Always a good time to talk about digital asset fund audits.
Well, there's nobody better to have this conversation with, so I'm so glad that you were able to join us for this.
Such kind words, but likewise, no one else better to have the conversation with other than you, Dave. So excited to be here.
Just touching stuff to get us kicked off here. Before we dive into the specifics, do you want to give us some background on yourself and on KPMG and your practice?
Yeah, sure. No, thanks for having me on the podcast, Dave. As I said, long-time listener, first-time visitor here. Just before we get started, been listening to your podcast since you started releasing it. It's great what you've been doing for the industry and couldn't be more excited to be here. For those learning about the legal intricacies, of launching a fund, as exciting as it is, it's something which is tremendously useful to the space. So thanks for everything you're doing for the space.
Thank you. That's so kind.
So my name's Gautam Ganeshan. I'm a partner at KPMG in the Cayman Islands. Just to start off, as my views here are my own and not necessarily those of KPMG's. The content expressed here is educational and general in nature. Nothing in what I say are positions taken by me or the firm, and is a general overview of how we think about certain things. I'll ad-lib a bit from that, from your disclaimer as well there.
You're making me proud.
Thank you. I've been in Cayman for the last 14 years. KPMG is one of the global Big Four accounting firms focusing on audit, tax, and advisory. In the Cayman Islands, our practice consists of our asset management, insurance, and local company divisions, with audit, tax, and advisory across all of those spectrums. And then within our asset management practice, we serve digital asset funds, real estate, hedge, private equity, venture capital funds of all sizes, including emerging managers. And within our digital asset practice, we do work with funds across the asset class: systematic, fundamental, venture, and passive. I personally have been working in the alternative asset space for the last 14 years, but with a pure focus or a close focus on digital assets in the last 7 to 8, and really looking forward to our conversation this afternoon.
Awesome. Well, thank you for that intro. I think that's helpful to situate your experience and your what you do. So that's great. I wanted to have you on. As you know, I did an episode a few weeks ago with Salman Ali from CBiz, and we talked sort of about basics of fund audits. And so I thought this episode would be a great way to build on sort of that foundation. So if you're watching this or listening to this and you don't have any idea what's involved in a fund audit, it might be helpful for you to go back and listen to that prior conversation before diving in here, because we're going to build on some of those concepts over the course of this conversation. So with that out of the way, one of the things Salman was talking about is how audits change based on the types of assets that a fund might be investing in. And he told us a little bit about level 1 assets, level 2 assets, level 3 assets. Are crypto assets categorized in the same level 1, level 2, level 3? Or is there a totally different paradigm for digital assets?
Yeah, no, thanks. And look at you, Dave, displaying the accounting and audit knowledge picked up with Salman. So there you go. The short answer here is yes. Assuming that the fund meets the definition of an investment company and follows the fair value hierarchy framework that is outlined in US GAAP. And Salman, I think, went through what that is, so I'm not going to go ahead and repeat that. But one thing to note is to understand how digital assets are classified as compared to traditional assets. So the guidance in US GAAP indicates that as opposed to equities or debt, digital assets are to be treated as other investments, and then these should be measured at fair value. Another example of an asset class that's treated as another investment is real estate, for example. So on the whole, yes, crypto assets broadly follow the same framework as traditional assets in the fair value hierarchy, level 1, 2, and 3.
Cool. And then can you give us a quick example of level 1, level 2, and level 3 digital assets? I mean, I'd assume Bitcoin is probably a level one asset, obviously easily tradable, easily observable market price. What would be a level two or level three asset?
Yeah, so you hit the nail on the head there. So a simple example of a level one asset would be the well-known and highly tradable digital assets, and those specifically that are priced against a fiat currency, such as U.S. dollars or euros, etc. So examples of that would include Bitcoin, Ethereum, the currencies typically with the highest market capitalization. Now, a slight nuance to that as a level one asset, that is if a digital asset is not priced against a fiat currency, but say against USD Tether or Bitcoin, because of a requirement to report that digital asset in USD, which is typically the fund's reporting currency, we would classify that asset as level two. So just to take it a step back, we move it from level one to level two because you can't take the price directly from the market without adjusting it to a fiat. So that's a level one asset. An example of a level two asset would be a digital asset, which is only priced against another digital asset. But then also another example is a digital asset option or a derivative. And this would be for options traded on the exchange where the implied volatility is observable based on the traded price. And then the implied volatility is used to go ahead and price the option. An example of a level three would be a private investment, either private investment tokens or equity. And then there's a whole other discussion that we can get into on restricted tokens and tokens subject to lockup and coming out of a SAFT agreement if that's of interest as well.
Everything's of interest. Give us the highlights.
Great, and I'd love to hear the interest in audit and audit. So tokens coming out of a SAFT agreement or restricted tokens coming out of a vesting agreement are exactly that. So as projects go live, they have their TGE. Funds or investors who invested in the SAFT receive those tokens, but on a graduated schedule, on a vesting schedule. It does touch briefly on valuation, but these kinds of tokens are typically valued using an option pricing model. And one of the critical inputs into that option pricing model is the volatility assumption. And that's the volatility of the traded asset. So the volatility of the historical volatility of the traded asset is considered to be the implied volatility going forward. And that's what's used to price the asset as of the reporting date. A nuance is that given some of the vesting schedules in these digital asset restricted tokens can be significantly longer than a tradfi asset, 3-5 years longer, the time frame based on which the token subject to vesting has an impact as to where it falls in the fair value hierarchy, either a level 2 or a level 3. So where the vesting schedule is longer than a year, we may consider that to be a level 3 because the implied volatility is going longer. And where it's shorter than a year, we may consider that to be level 2. And the reason being is that the past a year, the implied volatility is considered to be an unobservable assumption or unobservable input. So just summarizing quickly, a simple way is shorter than a year, maybe level 2, longer than a year, maybe level 3. Obviously, there's a lot of judgment involved in that, so you need to be attuned to the specifics of the contract, of the comparable, and how it's valued.
That is super interesting, and it's different, I guess, than how I understood it to work in TradFi world. And I guess just drilling down on that concept of the judgment that you just mentioned, is that who exercises that judgment to make that determination? Is that something that the fund manager does when they're making these investments? Is it something that you do as part of the audit process, or is it maybe a combination of both?
Yeah, it's a combination of both. So, first the fund manager makes that determination and assesses where that entity or that asset would fall within the fair value hierarchy, and then it's a discussion. We have our internal specialists, our valuation specialists, who go through the exercise of valuing the asset, but then also determining the fair value hierarchy. And then it's a discussion between us as the auditors and the fund manager to go back to the principles in US GAAP and honestly analogizing a lot of what we have in digital assets to traditional assets. And as you know, there isn't a lot of authoritative guidance on digital assets written out there in US GAAP. So we kind of have to say, hey, what does this look like compared to TradFi? Does this fit? Does this make sense? And make some judgment calls and assumptions around that.
Yeah, that's kind of the theme of digital assets writ large, whether it's legal, regulatory, accounting wise, you're never quite sure where they fall. And so I think a lot of us practitioners in this industry are making judgment calls like that all the time. So it's great to see that us lawyers are not alone in that.
Yeah, no, definitely. I think we're all in this together, and we're all trying to just move this industry and space forward. So, to the best that we can, and come up with some authoritative guidance, I think would be welcomed by anyone. As I'm sure you, as a lawyer, can probably attest to, and probably excited
Yeah,
for what's happened in the last day or so.
absolutely. Absolutely. So, okay, that's super great perspective and background on sort of the different levels of assets and how they apply in the digital asset context. I guess broadening the scope of our conversation to the audit process writ large, are there, is the scope of an audit of a digital asset fund, broadly speaking, the same as the scope of an audit for a TradFi fund, or are there specific differences in the overall scope?
Yeah. So again, it's one of those things, right? Audits are largely similar at a very high level. There are, however, some slight nuances and different complexities to a digital asset fund audit compared to a TradFi audit. Broadly speaking, we want to make sure that the investments exist, they're valued appropriately, and that the transactions occurred, or, they actually did take place and they occurred, both in a TradFi audit and a digital asset. And I can touch on each of those in further detail. So from a existence and ownership perspective of the investments, as you know, investments are one of the key focus areas, or if not the most important focus area of a fund audit, being the largest position typically on a fund's balance sheet. And speaking to digital assets, there's a couple different ways for fund managers to custody digital assets. So third-party custodians, hybrid custody as a service by third-party service providers, or self-custody solutions. Touching on each of those in turn, third-party custodians is probably the most similar to a TradFi audit, and this is
Yeah.
where the fund manager decides to custody the fund's assets with one of the third-party custodians that are in the industry. Similar to a TradFi audit, the audit team is going to send a confirmation request to the custodian, and they're going to receive information in some manner or form, an email, API access, or access to the platform. And they're going to then be able to look to compare the information that they're getting back from the custodian to what the fund administrator has recorded for the fund. One thing to consider and note here is that whether or not the custodian has a SOC 1 report, and that's a service organization control report over the controls in place at that custodian, if they have that type of report or not, does determine or does have an impact on some of the specific procedures that the auditor may have to perform.
Is it more, just on that point, is it more, do you have to perform more detailed procedures if they don't have a SOC 1 report?
Exactly. Yeah. So you're going to have to perform specific procedures over balances at a custodian where a SOC 1 report may not be available to get comfortable with some of the balances there.
Got it. Okay.
Yeah.
Sorry to interrupt you.
No, please. So on the second option, the hybrid method, where there's third-party solutions out there which offer custody as a service, MPC custody, we consider there the managers just to still maintain custody of the digital assets because they have the back of the private key. In this process, or in this example, what we'll do is we'll gain an understanding of how the manager safeguards the devices, safeguards the process over the transactions, or over executing transactions. And what we'll want to do is test the ownership of the wallets through the manager demonstrated control of the wallet. And that can either be through signing a transaction, or it could be executing a microtransaction. We do have some clients who don't want to execute microtransactions. And so what they'll do is they'll sign a transaction, and then we have proprietary tools which we've developed to match the hash of the transaction to the public key. And then the third option there is self-custody. So, we've talked about third-party custody, hybrid custody as a service, and then self-custody. And this may be situations where it's a new blockchain, custodial solutions haven't yet been developed for it, or the manager believes they're in a better place to custody the asset. Again, similar to scenario number two, we would want to test the controls in place that the manager has around safeguarding the devices or any other platform that they're using as a self-custody mechanism. And we'll test the ownership of that through them executing a micro or signing an offline transaction. The important consideration that we do have, that we discuss all the time with our clients in scenarios number 2 and number 3 is what we refer to as segregation of duties. And that's where the segregation of duties that management has in place so that one person doesn't have full access to all of the digital assets. Now, I touched briefly on the proprietary tools that we've developed, and we do so because we want to be able to rely on the tool in order to be able to rely for audit evidence purposes. But we need to understand how the tool works and how the tool operates. And so that's why we've gone ahead and done that ourselves in terms of developing the proprietary tools to do that. And so that's helpful to some clients who don't necessarily want to execute microtransactions for whatever reason.
Very interesting. And so if I could just quickly summarize, and please tell me if I get this all completely backwards. If you're using third-party custodians, it's probably the most comparable to tradfi, where you, as the auditor, can reach out to the custodian and get, match up their records against what you've gotten from the fund administrator. And depending on I don't know if sophistication is the right word, but I'm just going to use it anyway. Depending on the sophistication of the custodian and whether they have a SOC 1 report or not, you may need to perform additional procedures to further verify that. And then if the manager is using a hybrid custody method or self-custody method, there are more proprietary procedures you've developed to help you verify the existence of these assets.
Yep, exactly that, Dave. I think you're ready to step into my shoes.
Not to reduce things to easy and hard, but it sounds like if they're using third-party custodians with SOC 1 reports, that's probably the easiest process to verify existence. And if everything's self-custodied and, they're reluctant to doing microtransactions, you're probably going to have to do more work to verify those transactions. And so, in a vacuum, putting all else aside, I would assume the latter method is more expensive and time-consuming to audit.
Exactly. There's more effort there. So that was from an ownership perspective. And I know I'm using these words like ownership and existence and valuation, and those are just different ways of the audit assertions for us to be able to get comfortable.
Yep.
The fund owns it exists, and they're valued appropriately. From the existence perspective, are the assets there, right? Like, do they actually exist? In a tradfi context, the confirmation from the third-party custodian would go ahead and provide that evidence. You touched on it just now, but in a digital asset context where funds are custodying their assets with a third party, that confirmation helps to inform us that the assets are there. In scenarios number 2 and number 3, where there aren't third-party custodians, but it's a wallet address on the blockchain, we go ahead and we restore that wallet address to be able to get comfortable that the assets are there in that wallet. And so at KPMG, we've developed our own software called Chain Fusion. And so what Chain Fusion does is it integrates with blockchain API services, enabling us to efficiently use the data from multiple blockchains in a reliable and consistent format. And this allows us to be efficient with our clients' audits. So it goes back to what I was mentioning earlier. If we're using a tool for the purposes of our audit, we need to be able to understand how the tool works and be comfortable with the tool and how that operates.
Yeah. Who came up with that name? Chain Fusion is very cool.
I don't know. It's a great name, isn't it? KPMG marketing. So KPMG.
Nice.
So that was existence. That was ownership. So in terms of how that compares to kind of a tradfi audit, overall, broadly speaking, the same, but there's some conceptual differences there. Turning to valuation, again, another key focus area for us as auditors is, are the investments appropriately valued? And so we've talked about the fair value hierarchy framework, and it might be easy to talk about it thinking from the level 1, 2, and 3 perspective. Starting with level 1. So, if we take a tradfi example, a well-known public company, say Apple. Apple has a primary exchange where it's traded, and we can go ahead and obtain the price from that exchange. There's tried and tested methods and methodologies over decades in order to be able to determine what that principal exchange is, and there's established pricing aggregators there that the market generally relies on. With digital assets, however, there's not one pricing source or pricing aggregator where we're able to understand the mechanisms by which the price is derived. So what do we do then? So we look to the principles of, I say US GAAP, but could apply just as well to international financial reporting standards and IFRS in terms of understanding how do we go ahead and value it. And what the standards say is that to take the last traded price from the principal or most advantageous market. And so the principal market can be thought of as the market where the entity enters into transactions to sell the asset. Mm-hmm. But because digital assets trade on so many different exchanges, entities and funds should consider what their principal market is. From our perspective, we go through an analysis of the different exchanges and venues which are known to be reliable, and we have APIs into each of the pricing venues, prioritizing those venues with fiat pairs. We do see often the case that clients do want to use pricing aggregators, just coinmarketcap.com or CoinGecko or others in order to price the asset. However, for financial statement purposes, US GAAP says the price should be taken from the principal market. So that's level one, which is probably a bit different compared to between digital assets and tradfi assets.
Yeah, it sounds a little different, though, similar in concept.
Yeah. Level two is actually even more similar. So broadly speaking, the methodologies of valuation of investments in digital assets are similar to tradfi. So going back to the example before, a digital asset option, a derivative, very similar between digital assets and tradfi assets. Likewise for level three, when we look at private equity investments, venture capital investments, very similar thought process as to a tradfi fund and a digital asset fund. Last round of financing, a market multiples-based market approach, both similar instances to be used between the two industries. However, one thing which you may see more commonly in tradfi is the use of the income approach, so what we call a discounted cash flow approach. Yep. Because of the relative early stage nature of these types of companies, digital asset companies, that's a bit harder to use. So that's just something to be aware of. Now, touching on private token deals on SAFs, because that's a completely different kettle of fish. I think I used that right.
I think you got it.
Compared to equity investments or tradfi investments. And so I mentioned it earlier, but GAAP says that digital assets are neither equity nor debt. And so because of that, while there are some similarities in how we approach an investment in a SAF compared to a private equity or venture capital investment, there are some slight differences and some slight nuances. And so this is where we involve our specialists to a greater level of degree to get involved in the tokenomics of the project, the technical feasibility of the project, the governance of the project, and understand our clients' due diligence over that. So that's level 1, 2, and 3. And then, I can talk about restricted tokens as well, but also I'm happy to move on if
No, I mean, I think what's interesting to me I think I understand level 1 and level 2 and their similarities and slight nuances from TradFi. I think level 3 is where I have trouble wrapping my head around. If you take the example of a private token, a SAFT, something like that. I know Salman spent some time explaining the differences between the market-based approach and the income-based approach, and my understanding of that, which could be wrong, is that the market-based approach is you kind of look for comparable public companies to the private company that you're investing in and try and make some comparisons and ascertain the value that way. I guess in the context of a SAFT, is that what you're doing also if you're following the market-based approach, or is it a total, are you looking for similar issuers, similar tokens, similar projects? And if you are, is it similarity of what the underlying token is intended to be doing? Is it similarity on tokenomics? Is it similar? What similarities and differences are you looking for? Maybe it's some combination of everything.
Yeah, and unfortunately, probably it's going to be answer is going to be not what you're hoping for, but it's something where a market-based approach to value SAFs is something which we haven't seen. So to take it a step back, a market-based approach involves looking at a public company and seeing what the revenue is, or seeing what the EBITDA is, and basing some sort of a financial metric. As you can imagine, SAFs token projects don't necessarily publish those metrics to be publicly available. And so to make those comparisons, therefore, obviously can be quite challenging. To be able to rely on those can be quite challenging. So typically don't see a revenue-based approach or multiples-based approach to value SAFs. Where there is maybe a similarity between traditional VC is the use of last round of financing. So, SAF projects may raise multiple rounds, or there'd be multiple SAF rounds. This was especially the case, a number of years ago, so I'm sure you recall. An aspect to be aware, or something to be aware of there, is the different vesting conditions and the different economic rights. So, earlier SAF rounds may have more favorable vesting conditions to the investor. And as the project's getting closer to launch in TGE and they raise another round, those vesting terms may not be as favorable. And so it's something to be aware of when you're looking to benchmark to a subsequent SAF round. Is, it's not necessarily apples to apples, and there may be some sort of element and adjustment that you may have to make there. So those are things to be aware of in terms of trying to apply the market-based approach to a SAFT and to a SAFT.
Sounds challenging.
Yes, indeed. So it does take a bit of our time, and it does take quite a bit of our specialist time. Really quickly, I want to touch on restricted tokens and locked tokens, because I'm not sure about you, but we're seeing quite a bit of that from our clients. And so this is something that's also different compared to TradFi funds. We see some entities who do want to take a flat discount percentage of the discount rate of the market price. But however, given the volatility of the assets and the uniqueness of each asset, that can be challenging to support. So the practice we most often see in terms of valuing these restricted tokens or tokens coming out of a SAFT agreement is the Black-Scholes put option model. And that's being used to value the fair value of the restricted position. In essence, it calculates what it would cost you today to be able to sell the tokens you're going to receive at each vesting date. So it's not too dissimilar to a farmer or a commodity producer wanting to hedge the position when their crops or goods are going to be ready in a few months' time. Based on the time period of the vesting schedule and the trading history of the subject token, the fair value hierarchy classification may be either level 2 or level 3.
Wow. Okay. Great. I think I followed most of that, so that's great.
Well,
that's great.
Always
for me.
happy to get on a call with you, Dave. Some more.
Thank you. I appreciate that. Okay, so I think you've given us a very solid high-level understanding of the sort of unique challenges and differences in a digital asset fund audit, especially when we're talking about verifying existence, ownership, valuation. Are there unique challenges we haven't discussed yet? Is there anything specific to digital asset fund auditing that we haven't touched on yet that you think is pertinent to mention?
Yeah, just a couple of brief, quick things. Data extraction from data is always something which can be a challenge. Digital assets are bearer nature, and then segregation of duties. So just touching on each of those briefly, it's an area where we spend a lot of our time is extracting the data from exchanges and reconciling that to what the administrators recorded. So to slightly step back, as auditors, we take what the fund administrator has recorded, and then we've got to go and get independent, sufficient, appropriate audit evidence to verify that to within our materiality standards. And one of the key steps we do for a digital asset fund is to obtain that data independently from the exchanges, the OTC brokers, et cetera, the other counterparties of the fund, and be able to reconcile that to what the fund administrator has recorded for purchases, sales, transfers, deposits, et cetera. As I'm sure you can imagine, while the space has evolved and continued to mature significantly in the last few years, at times the tooling and the data availability can be challenging, which just add complexities and difficulties. Mm-hmm. Another example on digital assets compared to TradFi is that digital assets are bearer by nature, right? If you have it, you own it, you possess it.
Yeah.
So an element we pay particular attention to is the flow of assets within the fund's ecosystem. So meaning that how does it go between the custody wallets, any self-custody wallets, any sort of smart contracts which are vesting tokens. And so we want to understand and perform procedures to understand that any withdrawals being made out of the system are being done so is in the purposes and context of the fund. And so that requires us to obtain the full listing of wallets and custody accounts to understand the fund's interactions. And then following on from that, I talked about segregation of duties, and it's something which, applies both to self-custody accounts and self-custody mechanisms, but also exchange accounts and platform accounts. We do see at times insufficient controls built in around a whitelisting process or controls around the movement from exchange accounts. So, in an ideal world, we'd want to see two individuals or multiple individuals whitelist an address off an exchange before assets are moved off there, or a dual approval process before assets can be moved off the exchange. So data completeness issues pertaining with integrity and completeness around wallet addresses, and then controls around segregation of duties are challenges pertaining to digital asset fund audits.
So on the segregation of duties point, what do you do if you have a new emerging manager and they don't have, they only have one senior person who they feel comfortable could approve something like that? Is that a function that they would outsource to an administrator, or is that, just something you're then going to have to overcome if they can't check that segregation of duties box?
Yeah, that is something that is of concern. And so we do want to see how are they considered. They're different. We do want to see how they're considering that. So there are different custody options, as you know, that are out there in the marketplace, which can help to resolve that. And so if there is an option that is available for that particular asset, then it's something that, want to understand why the fund manager hasn't gone ahead and chosen that particular option. And as a best practice, that's what we'd expect to see as this space continues to mature.
Great. Well, thank you for that succinct yet very informative description and explanation. I think I've certainly got a better understanding of the digital asset fund audit nuances. So I think I want to move on from there, and I know we're kind of running up against the clock, but I want to hear a little bit more about your practice and how you run your practice. So, first question I want to ask is, how do you typically charge for your services? Is it a flat rate? Do you, is it entirely project-based? How does that work?
Yeah. So our fees are generally fixed, and that's primarily due to independence considerations. But broadly speaking, our fees are based on the complexity and the volume of the fund's activities. So fund with limited trading volume, highly liquid portfolio, external custody, that would be a different fee as compared to highly illiquid or self-custody with a number of different counterparties. So there's a number of different mechanisms and factors to consider as part of the audit fee. So what's the quantity and frequency of the trading activities, the number of self-custody wallets, how many counterparties do they have, how many sub-accounts on the exchanges do they have? And so that's something which we speak with our prospective clients to be able to understand what they're thinking in terms of what that strategy would look like, and work best as we can with them to develop a competitive fee.
Yeah, I think the one thing that has become most clear to me over the course of this conversation is your articulation of the various factors that make this audit process more or less complex. And so I have a much better understanding of, why Fund X might get a quote for Y dollars and Fund Z might get a quote for 100X Y dollars. It makes perfect sense to me now.
I'm happy to offer that insight.
So if you were a new digital asset fund manager, what should they be thinking about in terms of choosing the right auditor? How do they make that call?
Yeah. So one thing I think is tremendously important is knowledge and specialization in the industry. So you want to choose an auditor who's knowledgeable and has experience in the specific type of industry you're choosing to work with. So in the case of digital asset funds, alternative investments broadly speaking, but then also more specifically digital assets. Hopefully, as I've been able to outline, there's a bit of nuance and complexity to digital assets and to digital asset fund audits. And so an auditor who understands these will be able to save the client time in completing the audit. We put a lot of effort and time and investment into recruiting and training our team members who focus on digital assets. So they're asking the right questions to the client. There's definitely a certain level of technical investment in our people, our team, and our tools that's needed in terms of auditing these types of funds. So, does the auditor have that? How do they go ahead and examine the blockchain? What are they using? How do they rely on that? Do they have the appropriate specialists? Those are things to consider. And then another thing to consider as well is transparent pricing. Are the fees quoted a bit of a black box, or has the auditor taken the time to walk them through the challenges of the work that they're going to have to perform and how their fee is considered and developed?
Makes sense. So do you have a conversation like this with new fund clients and walk them through, this is why I'm giving you the quote I'm giving you because this is the strategy as I understand it and the custody arrangements?
Exactly. So, we walk through the client's arrangements. How are they custodying? How many exchanges are they going to be on? Are they going to have sub-accounts? Is there self-custody? Is there DeFi? A whole bunch of different questions that we ask to be able to develop something for them that's specific and tailor-made for their fund.
That's great. Makes perfect sense. So last couple of questions I'm going to ask you are sort of along a similar line, but are there common issues that you see that an aspiring fund manager could seek to avoid if they're just about to get started?
Yeah, I think one of the biggest things is probably communication. It's what we tell our clients all the time is, we want to hear from you. And so I think one of the big thing is what is communication with us, with the auditors on a regular basis. And that may be akin to specific platforms or protocols, which, may have restrictions in how far back you can go. So in terms of retrieving data. So if that's known, talk with your auditor ahead of time for them to be able to independently go ahead and retrieve that data. During the year, fund managers change strategies, change venues, which completely makes sense. But when they go ahead and they close accounts, they lose that access to that historical data, making it difficult for auditors to be able to do it. And then there are some instances where funds open accounts in the name of the GP or the IM and not the fund. And so that's one of the things is to make sure that in that instance, it's hard to get evidence over the ownership of the fund's assets. So I think the overarching thing here is communication with your auditor is hugely important and can definitely help to make the process smoother.
Well, that makes sense, especially given all that you've described here today. If I'm going to open up a new account at a new custodian, it's going to be relevant for me to figure out if they have a SOC 1 report or, how things work at that custodian and, picking up the phone and calling you and saying, hey, I'm evaluating custodian A and custodian B and custodian C. What do you think? And it might help you and keep your quote in line because the estimate is staying in line with what you expected.
Couldn't have said it better myself.
Awesome. And then, similar question, but maybe there's a different answer. Is there anything managers can do to proactively make the audit process more efficient? I mean, in addition to proactive communication?
Yeah, I think just, definitely there's a couple of things. And so communication, 100%, we want to hear from our clients. We want to help the business. We want to be able to understand what we can do and help to address questions. Another thing is hiring the right personnel. So, the fund manager, let them focus on the strategy, the execution. It may be helpful to engage a third-party outsourced CFO solution or COO solution who can interact with the fund administrator, the auditor, and deal with the other operational matters. And that just frees up, bandwidth and capacity to focus on the trading, strategy, fundraising, everything else that goes on in running a fund. And then another thing is developing necessary policies and procedures. So develop a custody and safeguarding policy, develop a whitelisting policy, a valuation policy, and also a key recovery policy, so disaster recovery policy. So you want to be able to have that in place so that one, the operations throughout the year are efficient and effective, but then two, it's also, the valuation policy isn't something completely, which may not be compliant with US GAAP or IFRS. So a couple different things there to help make the process smoother.
Awesome. Well, thank you for that information. I think everybody listening is a little bit smarter for having heard from you. I really appreciate you taking the time to explain all this to us and joining me here in the Tokens of Wisdom studio.
Well, thanks for having me. As I said, it's it's great, the podcast and what you're doing for the industry and pushing this space forward. So thank you for having me. And yeah, it's been a great conversation.
Yeah, likewise. Thanks so much. We'll talk soon. Thanks for listening to Tokens of Wisdom with Dave Rothschild. I hope you enjoyed this episode. Please like, follow, and subscribe to our show wherever you get your podcasts. Well, now that all that boring stuff's out of the way, it's time for the part you've all been waiting for. The legal disclaimer. In this show, I describe laws and regulations from a 10,000-foot view. And while this should be obvious to most, I need to say it nonetheless. This show is for informational purposes only. And nothing I say here constitutes legal, investment, or tax advice. If you're thinking about starting a fund or you're curious about your options, this show is a good resource. But if you're going to pull the trigger and launch a fund, please engage an attorney to assist you.